Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel for our next topic after the close. And I'm your host, Kevin Horner. Thanks for being here today, everybody. We recognize that as traders, not everybody is going to have an opportunity to watch the market as frequently as I might, or as frequently as many traders do throughout the day. So a class like this one, after the close, is designed to give you a way to look at charts, get an idea as to what could be coming in the following day, but basically to rely on today's closing market to set yourself up for what could be opportunities in tomorrow's market. So that's what we're here to do today. We're going to look at a bunch of charts. Some of these charts are going to be charts you're ready to act on, potentially, from a trade example standpoint, which is what we'll do in the class, of course, looking through some of our example trades historically, building new example trades as well. But I want to highlight some trades that might still be working from an example basis for traders, but might not be necessarily setups that'll be getting going tomorrow, which is to say some of these might be trades that have worked in an example basis for the last week or two, but could still be implemented or still be trending, but might not be the type of trade that a trader would enter with tomorrow's market, for example. But of course, I'm going to show you some positions that do look like potential opportunities for examples of ways traders might get going on tomorrow, opportunities nonetheless. So hopefully that makes a little bit of sense here as we work through everything with you all today. So again, thanks for being here. I am joined in the chat today by my friend James Boyd. JB and I do host our Friday class together, Trader Talk in Today's Market, where we focus on using exchange traded funds. We do that every Friday, so you can expect to find us together tomorrow morning here on the channel at Market Open. So I'm just going to do a little self-serving comment there because that one is live exclusively, everybody, because we talk only ETFs. We do not archive that class. If you'd like to see that Trader Talk, gotta be there live. So if you're there, terrific. We look forward to seeing you there tomorrow. Now, make sure you're following JB and me on X, James Boyd CS, and Kevin Horner CS, a great way to engage with us outside of the classes that we host for you here on the channel. All right, let's get to some disclosure detail, and that way we can jump into the discussion. Remember that our conversation is exclusively informational and educational. We do not make recommendations here. We do not make endorsements for specific strategies to trading the market. We will talk technical analysis, though. In doing so, remember that technicals are just a piece of the puzzle. We discourage you from basing decisions exclusively off what technical analysis might suggest. We do also want to remind you that options carry a higher level of risk and are not appropriate for all investors. You do need to be approved on each account in which you would like to trade options here at Schwab. You want to be familiar with the characteristics and risks of standardized options disclosure document, and we can get that to you at any time with a quick phone call here. So don't hesitate to reach out. Remember, we have representatives, trade desk representatives available to talk with you 24/7 every day of the year. One other thing as it relates to options, everybody, since we are working in a paper money version, it's important to know that anytime you sell options in a paper money account, you will not get early assignment. However, this is a risk associated with selling options in real life, of course. So it's important to know that even though you might be selling options that are out the money, and in being out the money, you might not expect to get assignment on a short option, but option assignment in a real trade scenario on short options can happen at any time, any day, up to and including expiration, even those contracts that are out of the money. All right, so we are going to dive right in, everybody. I'm going to talk briefly with you here about what we're seeing in the semis and the S&P 500. So the S&P 500 today gave us day 64 of holding our 20-day moving average. We've had a continuation move, essentially. Now, it wasn't as broad-based as maybe some of the moves we've seen lately. The S&P was up fractionally. We had the Dow Industrials off about 0.75%, NASDAQ up 0.25%, and small caps taking it on the chin today after having a breakout day yesterday. Small caps pulling back a little today. Unclear what we're getting necessarily from small caps there. because we did have a bit of a bearish divergence. So we'll have to look at that tomorrow morning and see if we've gotten maybe a deeper pullback, maybe another 20-day moving average test in the small caps. We'll see how that plays out. But one of the things that we discussed this morning in the Trader Talk was the semiconductors and the goal to see if we could get that group right back above that 20-day moving average, everybody. And again, it was very close. So Tuesday, we closed above the 20-day. Yesterday was very close, but we closed above the 20-day. It was 56.37 as was our closing value yesterday, and the 20-day was at 56.34. Today, the 20-day at 56.42, and we closed again at 56.44. So while you have price action over the last 3 days that has intraday deviated in the semiconductor index beneath the 20-day moving average, we have somehow managed for those 3 days to close above the 20-day moving average. That does stand out to many a technician. So maybe some traders are going to make note of that. Maybe we're looking to see, can we officially call today a close above the high of the low day? If yesterday was the low day in the pullback, as brief and quick as it might be, today is in fact closing above yesterday's high trade. The high trade there was 56.42. Our close today, 56.44. So once more, technical analysis 101 continuing to hold as it relates to the trend here in the SOX. I thought that was a little interesting and just wanted to follow up on things there today with you all. Now, as I said, I'm going to rely on a watch list that it's got a few positions in it, not everything that I want to look at, but I did want to work through some of these symbols and just briefly remind us that not every setup is going to be ideal in this particular class. So when we start talking about the process here, the reminder I want to offer again is that in an after the close approach, what we're looking for are trades that are apt to be ready to go as early as tomorrow. It doesn't mean they're going to occur, that we're going to be in positions working tomorrow morning necessarily, but I do want to differentiate between maybe continuation moves in some of these positions and trades that are going to be initial starting points for somebody wanting to open a new trade. So a couple of those examples. Let's look at, QBTS here in that quantum space. QBTS has been interesting, but let me explain why it's not necessarily one for an immediate trade. Now, it could be just fine. Many a trader will look at this and say, well, Kev, we've got a glorious pullback. We had a wonderful run up, and then we've just gone, pulled back to the 20 and 50-day moving averages. And there is nothing from the technical standpoint on this that suggests this is not an opportunity for purchase. It may very well be. Here's the reason that it doesn't make the cut today as a potential setup for tomorrow. While traders will point out that we've had the broken downtrend line and a continued move higher to new highs and the rising 20 and 50-day moving averages, if we were to build a trade from here, the likelihood is we have to look at a violation of 1612 on a closing basis, the equivalent to the 50-day moving average, of course, as a point at which we would say this trade's no longer working. Now, can a trader put on a position right now with $3.64 approximately of risk? Of course you can. You can tell yourself a story that there's an opportunity here, right? Good point, Jay. I'm glad you mentioned it. Yes, we have earnings coming up, and obviously on a lot of these charts, we're going to hear and be aware of earnings coming up. Here it's August 7th, so a couple of weeks. But again, the thing that stands out to me here is that our option, I guess, could be for the trader who says, yeah, I'm going to buy if we move to new highs. And again, we could validate that, but we're a little late to the party. It seems like the day we really should have given thought what would have been not today necessarily, but most likely Tuesday. with a test of the downtrend line. That was a one-day interesting move. Yesterday, trading above the high of the low day in that brief pullback could be that opportunity. And you'll note today we got up there again, tried to break out, but didn't. So you've basically got 3 of the last 4 days testing $20.50, but not breaking out. So can a trader position themselves? Sure. If you've been long in QBTS, for example, on an example maneuver like this, well, then the breakout here you're happy with, and you can utilize this confluence of the 20 and 50 as a spot under which you might place a stop order. That would make some sense. However, getting started on a new trade right here might only make a lot of sense through a new high in the trade. And that's certainly in the stock, rather. That's certainly a possibility, but not necessarily the setup for a new opportunity. So I wanted to work through that. Let's move on down the list. We had bullish action in Oscar yesterday that has been denied today. So one big, beautiful green candle to the upside, one not so big, beautiful inside candle here. Looks like it's fully engulfed today, but pretty tough. So we'll move on from Oscar because not much to work with here in terms of the new trend necessarily. We did have an ASTS continuation move. Again, a little bit behind schedule on this one, everybody, because we had this broken trend line maybe right about here after testing the 20-day. You know, we should have been looking at this about 2 weeks ago, right? Doesn't mean we can't be fine here, but what we're looking for by and large are these opportunities to start a new trade with a developing the beginning of something new occurring. Let me give you an example of what I'm talking about in terms of the right type of pattern here. I'm going to add it to my watch list as I go along. We're going to look at AMD here. And this is a bit more of what I'm talking about, everybody. Yes, AMD is at a new short-term high, but really the opportunity could be based on the broken downtrend line with yesterday's price action, right? Traded outside of it on a closing basis. And again, you know, this just looks like a really basic standard bull flag situation, whether you draw the pull from these matching lows back here, or maybe you went to the last real low we had back in this zone. You could go with any of those maneuvers. But now that AMD has broken the downtrend line here, many traders are going to say, all right, now I've got an opportunity for a little bit more of a continuation move, and we're a little earlier in the process compared to what we saw in QBTS, right? We were already popping to the upside, and we had already created a series of highs at which we were running into resistance. So here, we not only have a broken bull flag situation, but if we add more time, well, then we'll see that we've got opportunities to skate up to a ledge here, maybe above us in the neighborhood of 173 or so. That would be at least the last extended high, 174. So that'll give traders a target. And for a lot of traders, everybody, if we're looking at 12 points to the upside, you know, that is ballparks to about 4 points of downside. And that would basically put you under today's lows. So that's one of those opportunities, of course. One of those scenarios we can build a new position utilizing AMD. Let's do that with standard equity shares here, everybody. So what do you say? Let's zoom in. We're going to use 174 as our target zone for a bullish equity position. All right, not incorporating options on this one. But let's say, well, actually, let's go back and talk about that. Scott, since you're mentioning a target, let's give thought to something other than 174. Oftentimes, traders want to layer multiple exits. Let's suggest that instead of using the broken area here, let's use this move, right? The bottom of the last real flag up to the top of the flag that we just took out here with today's intraday action. So let's look at that. So the low here was 133.50. So we'll start our line there. at about 133.5. And then we're going to take it up to the flagpole height right around 162, I think. Let me just double check. Yeah, our high was 161.96, it looks like. Yeah, so right around 162. And I don't know if y'all knew this, but when you edit your properties on your lines, everybody, you can get very detailed here. So I'm just going to put this at 161.90. So you can actually put in the levels you would like your lines to be at, everyone, if you want to get really granular with your process. So I'm going to go ahead and duplicate that line, duplicate trend line 5, and then I'm going to add it to basically the 20-day moving average. And let's just see where that goes. And boy, it's in that same vicinity, isn't it, everybody? 174 up to maybe 177 could give you a ballpark on this maneuver, just on the next possible run, potentially, to 174 to 177. Instead of a line, some of you traders might just say, yeah, why not just make it a triangle? And if it gets anywhere, or pardon me, a rectangle, really, really on the ball today, everybody. I'm sorry, it's late in the afternoon. That is clearly a rectangle, not a triangle. But as a reminder, keeping those lines really fat and wide can be reminding us that we don't need to trade it to the penny. We just need to get into the vicinity of our target zone. Our friend Ben Watson often says you draw resistance and support with a big, fat magic marker, right? Big, very wide line. Make sure you're not too fine in our approach. Technical analysis commonly is not too particular, not too precise, as Ben likes to say, just like that cheeseburger in paradise. So with that, let's look to build the trade utilizing about a $4 exit strategy beneath the level that we made with today's lows, or excuse me, $4 from our entrance, which could be at tomorrow's open, hopefully close to 162. So we would look for exit around 158 or beneath it, probably beneath it. And then we'll target at 174, 175. And the reason we're doing that, we're trying to build a proper risk versus reward scenario here, where our risk is about 1 to 3 in terms of risk versus reward. Now, I don't know that I've spoken about risk versus reward in this class all that much, and because we do incorporate options here. But I want you just to give thought to why a 1 to 3 risk versus reward situation works out. So for many traders, if you're consistently entering a 1 to 3 risk versus reward scenario, then the likelihood is that you don't need to be right about your trading as frequently if you are constantly able to carry, or I should say not constantly, but at least 3 times out of 10 able to meet your maximum gain. So let me put some numbers to this, okay? Let's make it very basic. You place 10 trades, and each trade you place, you're buying ABC stock or XYZ stock, take your pick, not XYZ, because that's now that's a security, that's Square, but take your favorite position. Let's say you're buying it at $10 every time, and you either sell it for a loss of $1 or you sell it for a gain of $3. So we're buying at 10, we're either selling at 9 or we're selling at 13. Okay? Now, 10 trades down the line, you've been wrong 7 times. 7 times you bought at 10 and sold it at 9. You lost $1 on each of those 7 trades. Now you're looking at those 10 trades, your ego's taking a hit. You are -7 combined on those 7 trades, right? But on the 3 trades you hit, you are getting $3 for each one. You bought at 10 and you sold at 13 3 times. So that means that you are +9 on those 3 trades. Just 3 correct out of 10, and you are +9. Now, versus the -7 you've had, 10 trades down the road, you've been wrong 70% of your trades. And yet your pocketbook is bigger than it was when you made the first trade. Okay? Your +9 overrides your -7, your +2. As I stated, you might have an ego to deal with because you were wrong 7 out of 10 trades. But what you don't have in that case is a problem with your pocketbook, right? So the other reminder that's helpful is that as traders, we are right about half the time. So if we're right half the time instead of only 3 out of 10, well, then we can often note that this risk versus reward as part of our main principle will be helpful in not just making proper trades, but also being better at management of our risk and our balance of funds with which we can trade. Okay, so hopefully that was helpful, everybody. It's absolutely a process that many a trader considers when building equity-specific trades, not options necessarily, but equity-specific. So be considerate of risking $1 to make at least 2 or maybe more. Ideally, perhaps 1 to 3 risk to reward consistently. So that's what we're building in here with the AMD trade. So we're going to go ahead, placing a buy with custom. We're going to do an OCO bracket, everybody. So this is going to be a very simple approach for us. Now let's check our balances. We've got plenty of cash to work with. We can go with a 100 share position because we were always kind of working with about a $500 max loss comfort zone. So if we set up an order to buy 100 and we have a $4 approximate stop loss, then we're going to be risking about $400 on the trade, which fits. Okay. So as a way to get into this, we're going to set this up for tomorrow, utilizing and incorporating a day only order. And we're just going to go with a nice round figure here. Hopefully we get the opportunity at about 162 at some point today. Many traders will certainly be a little bit more fine in this approach. Not everyone's going to want to place a limit for the opening business tomorrow, but some might say, Kev, I like 162, but I want to be more confident I'm going to get in to the trade. And you might go with 162.50 or even 163. Remember, if you go with a padded limit, as I just suggested, which is to say a limit price above the current asking price, that's what we'd consider a padded or soft limit. When the trade comes up for execution, you always receive the or better scenario. So if you said 163 limit or better, and the opening trade was 162.10, you're going to execute at the opening ask, 162.10. You're not going to pay up to your limit. So that's why a padded limit might make sense on an entrance like this. So let's do that. Let's give it a little wiggle room. All right. Give us the opportunity to enter the trade. All right. Now, we're going to target 175, as I said, and we're going to make that a good till canceled exit. So reminder, if we build our trade with a day only order to execute tomorrow on the open, hopefully, well, we maybe don't want the trade to go longer than tomorrow from a purchase standpoint. But if we get any shares tomorrow, we need to make sure we're protecting whatever we get or have a plan of exit, however that goes. Okay. So make sure we have a good till canceled exit strategy on both of our orders, our limit sale at around 175 and our stop sell at around 158. And again, one thing that some traders like is to come beneath the level they designate and pick a non-round figure, something like 93 cents, 94 cents, not a 0, not a 5. So that'll give us something to work with and hopefully a little more wiggle room on this particular trade, right? So that's our discussion on AMD. Let's go ahead and send that one off. And we are ready for tomorrow's business, everyone. All right, I've got some more to look at here. We did have we talked about the semis just a moment ago, the potential for the semiconductor industry to keep moving. And we saw AMD here, but what about Micron? Take a look at MU here, everybody. Now, we're in an interesting spot. Earlier in the day, we could have been thinking about getting some shares or building a trade based on potentially trading above the high of our low day. However, it doesn't look like we got that at the close. In fact, the high, this is our low day. As you can see, we've got our low trade. That's lower than yesterday. So we did not get the close above the high of the low day. So Scott, like you said, I keep waiting for MU. We're getting close. It's not quite there. If a trader were interested in establishing a trade today, thinking that tomorrow could be that opportunity, how's that look, everybody? What are your thoughts? Would you be comfortable setting something up here based on what you're seeing from the pattern in Micron? We have had a good run. We've gotten back above the 200. We consolidated at it first and started to run. Then we broke the 20-day and found the 50-day. Some traders would say that all of the action you've had in the last 3-4 sessions is fine, and they're confident with this pullback, and they might want to be in here. They may very well have comfort. So let's talk about one thing we could do. Could we do a buy stop order here, trading on a basis through the high from 2 days ago on Tuesday? Sure, that high was 113. So could we put in a line at 113 and then say, all right, if we trade through 113, I want to buy the stock. So we could incorporate a buy stop order. Yes, we could do that. We could also say, yeah, dollar or 113 bid, price action at 113. What if we wanted some semblance of confirmation? Many of you have heard me speak on needing, as traders, to define what confirmation means to us. Not everyone is going to define confirmation the same. Some of you will wait for more days to validate being above a certain price range. Some of you want that absolute hold move. You want a closing trade above the high of the low day, in which case you can't necessarily act. And if you want a hold move, chances are you're not comfortable placing a buy stop that occurs at any point in the regular session, unless it's maybe in the last 3 to 5 minutes of that session, because you want a close above the high of the low day. Great alternative option to include, Wiley. Thank you. Yes, maybe a trader wants to make sure that the RSI is also above its 50 line when it starts to make that hold move. Could be 3 consecutive closes above an area of, in this case, support. So maybe the trader says, all right, we've pulled back. We've been below the 50-day for 2 days. Now today we close above it. That's day 1 back above it. Some might want to see day 2 closing on or above the 50. Some want to see a 3rd or 4th consecutive close like that. All right. So as usual, define your confirmation series. What is it? Is it level in price? Is it number of days? Is it a percentage of breakthrough? You all are giving excellent examples that you have been thinking about this. You are encouraged to work through those thoughts as you're building these trades. That is exactly what we want to be doing. That is what example trading is all about. So I'm so glad that you guys are all being thoughtful about this, because having those ideas ready to go is what's going to make your process much more efficient and give you a much more confident approach to trading here in the market. So with Micron, we're going to say one final example of how a trader could do. We're not going to place an equity trade on this one, but just one final example. If the trader decided that they wanted a 1% move through what they're deeming to be the important level, in this case, 113 a share, well, 113 times 1% would mean the stock would have to trade up to 114 and 13 cents. So some traders would look to add 1% on an intraday breakout as the validation for doing so earlier than a closing price. Does that make sense, everybody? I hope so. So in that math, I took 113 times 1.01 as a reflection of 1%, and we get 114 and 13 cents. And then that becomes an approximate area where a trader would say, all right, a 1% move through the high of our low day, that might give some traders more comfort to enter an equity trade like that. All right, so that's something for consideration on Micron, but we will not place a trade now. Now, let's move on to one that has broken down. One that was really hot for quite a bit here was CoreWeave. Let's see if the breakdown, okay, it has in fact broken, everybody. Here we have an interesting one to discuss because we don't often get too many frequent opportunities for bearish trades, but we're going to talk about this one from a bearish standpoint. I'm going to clear the drawing set. Now, why are we bearish here, y'all? Let's hear it. What is it? Give me your comments in the chat. We have not only have we got a filled in candle to the downside with the stock closing at its low of the day, but what has gone on in the past week? We have 5 consecutive now closes below that pink line. That pink line is our 50-day moving average. We are perhaps at a spot where bearish traders are comfortable establishing something to the downside here. Looks like it could be a bit of a bear flag if the trader was to evaluate it as such, moving from this point to this, and then our flag might have been kind of like so. And you'll notice that our highs have been met in this vicinity, but not able to hold. So yeah, this looks like a bit of a bear flag breakdown. Yep. Below moving averages, both of them, both the 20 and the 50. Break of support, absolutely. Moved up too fast, and now it's reverting to the mean, sure. And across the 50 to the downside, we've got declining RSI. And not only declining RSI, everybody, but when we started to pull back, we didn't get any of those holdups along the way at levels we would generally hold in what could be considered to be a bullish bias on a trend, right? Here we have a breakdown. We are under or at the 40 line. If we were still witnessing bullish behavior, the greater likelihood is the RSI would have maintained between 45 and 50 as its pullback zone for oversold conditions. If we push the RSI down into the 30 level, well, then that basically confirms new shorter term downtrend, and it's going to take much effort out of price action to turn this new downtrend into a new short-term uptrend. Now, typically, William, many traders would point to the declining volume as not a big concern. However, tomorrow, there's a potential opportunity to see some momentum-based selling with this type of close. Think about it like this, everybody. If this were inverted, if the why don't I show you that? Let's just take a look at it like this. What if I did CRWV minus a negative CRWV? I don't know if you knew this, everybody, but you can invert your chart. Did you know that? I always love that, and I don't talk about it frequently enough. But sometimes it's hard as traders to understand what we're really seeing because some of us are just mentally built to look for bullish opportunities. Check that out. If I were bullish and I saw this pattern developing, wouldn't I be ecstatic? Wouldn't I be interested in what's developing here? I probably would. New short-term high, broken resistance. This is very interesting. You flip things over. Thanks, JB. Yeah, if only we could invert the P&L too. I think this is an interesting way to look at things, everybody. If you're struggling to see the approach that a bear might have, a bearish trader might lean into, this is one way to think about it. But the price action itself might very well be sufficient, right, to go ahead and set up a bearish trade here. But I wanted to cover that one. Let's build a bear spread on this one. What do you say? We have a couple of options. Again, everybody, this is real simple. You're just going to take, instead of the symbol by itself, just put a minus in front of it and put the symbol in. And now you've got the inverted chart. All right. It is a really nice way to just shift your perspective, right? Perspective is everything. So change your perspective a little bit, and it might help you understand some of the patterns, the trends as they're developing. Yeah, just the minus in front of your ticker, piece of cake. All right. So if we're looking at CoreWeave, and if we are believing that we have a bit of a breakdown from here, how could we profit in an option scenario? We have a couple of choices. One, if we wanted to, we could devote capital to the trade. We could buy a long put and sell a short put at a lower level. Not every trader is going to want to devote new money to a trade, though. So some might say, hey, let's go ahead and do a short put situation, a short option situation, in which case, to stay bearish, we would want to sell a call spread above the current market. All right. And so that just comes down to which trader are you, the trader who wants to spend and outlay dollars to the trade, or the trader that wants to bring dollars into the trade. So yeah, David, I think short call vertical makes a little bit sense here. And we have in the past in this class done long vertical spreads, in the manner of the trend. And we could certainly do that here, but let's go with the illustration of a short call vertical that would basically be keeping us under the 50-day moving average, given the breakdown we've seen. So a few things for consideration. We've got earnings coming up August 12th. Not too far, but also not too close. So we can work with a couple of different series to consider. So we'll have to give thought to that. And we are trading at the close at 120. So we've got a potential for about a 15 to 20 point spread if that's our comfort zone. Let's see how those numbers shake out, everybody. Going to jump to the trade tab. And a reminder of a cheat to just determine which one of these options series is going to carry the earnings window. It's going to be easy by just looking at the implied volatility numbers, right? So if we want to incorporate the implied volatility from the earnings week, August 15, we absolutely could. Those premiums are going to be juicy. And some of you might say that's perfect because even though that contract, that series will incorporate the earnings window, it doesn't mean you have to hold it for the earnings window, does it? It does not. So let's consider, I'm going to go out to 40 total strikes. And I mentioned 135. What do we want to see when we're selling puts? Well, one of the things many traders want is a higher delta. I want to point this out. Look at the 135 level on the long put, or on the put side, 51 cents. Now that's pretty different because if we go to the week earlier and look at the 135 strike, sure, the premiums are lower, but our delta is higher, right? So if you're thinking about this and saying, yeah, I want something that's going to give me more dollar for dollar movement in the put option contracts, perhaps you want to consider the August 8th rather than August 15th, or at least it needs to be part of your decision-making process, okay? So let's go back to the 15th. We're looking at the 135 as the short side and maybe 115 as the low side. All right. And again, that's just based on trying to build about a $20 move into the trade. And let's see if we can make that make sense for us. So if we were, now I'm on the put side here and I was talking calls, everybody. I was going to have to shift everything here. My apologies. We want to be sellers of calls at the 135 strike and then picking them up to cover lower. So let's build this in a proper way, everyone. If we are selling on a breakdown, we want to only be basically working against ourselves at about the 50-day moving average. So we want to consider 135 as the upper portion for our sale, okay? So let's take a look at 135 is basically our purchase of the call, and we would be selling something deeper and further away, okay? So perhaps we would be looking at the 110, the 115, which gives us a $20 move, right? Now, if this goes in our favor, selling the 115 call, owning the 135, so we have a $20 spread. Where is this becoming profitable for us or really ideal for us? Well, it's under 115. So we absolutely need to have CoreWeave under the 115 for us to be gaining value from the trade. But we put on a $20 spread opportunity by bringing in the credit. The credit is the maximum gain, assuming that we do not put ourselves in an assignment situation. If we don't take on stock here, then our worst case is the difference between the strikes and the amount of premium we bring in. So here, essentially, yes, we are only bringing in 620, where, as you'll see when I click confirm and send, our max loss is double what our gain opportunity is. But the trader looks at this and says, I have a higher probability trade working, and while I'm not getting as much in terms of risk versus reward, the trader is believing that they've got a stock that is absolutely in the form of a downtrend. And so that trader says, I'm trying to bring in premium here. I'm more interested in the credit than I am the risk associated with it. And again, 1380, where does max loss come into play for this trader, everybody? With CoreWeave back over 135. Does anybody have a feeling that maybe that's very quickly going to occur? Based on the trend analysis, I think many traders would suggest that's not likely to be the case. But as always, when we're placing these trades, we have to know that that is a possibility for us, don't we? So, yes, the premium will be limited relative to our opportunity for loss, but that doesn't mean it can't work out. So let's go ahead, and exactly right, Vic. The $20 spread difference minus what we bring in gives us our maximum loss. And in any credit trade, the amount we bring in, the premium we get, is the max gain on the trade. So we're going to go ahead and apply that. You know what I'm going to do is go down to a limit of $6, which will give us a greater likelihood of gaining execution on that trade, everybody. Now, again, we're going to leave that as a day-only order for tomorrow's business only. If we can put that spread on for a $6 credit, we'll take it. So again, this is kind of a added limit opportunity on the trade for tomorrow. And then one final reminder on that, everybody, is that when we have the trade that brings us a credit, if that credit is 600, as we see, and we get to a point where CoreWeave continues to fall, and we look up and we have a credit that started at 6 and is now showing, say, $500 of profit, and we only can make an additional 100 by maintaining it through expiration. Don't forget, on those short positions, everybody, traders can cover that early. Yeah, you brought in 600 on the trade, but if you're willing to walk away and say, you know what, I brought in 6, but I'll pay 100 now to close it out and end that trade because I don't want the risk of a reversal coming into play. There's always the opportunity of a reversal, of course. Many traders will take their 80% of their credit and walk away, pat themselves on the back for a trade well made. So one thing to keep in mind, we'll take a peek at that next go round. Now, I can't make any adjustments to my unallocated orders that we've established because our order on AMD and the order on CoreWeave both are ready for tomorrow's business, but I'm going to try and move those into our after the close segment here later on tomorrow. Now, the only other trade we had was this Nebius put, $55 put that's in the money right now, but we're not going to have an opportunity to review this one. This one does expire tomorrow, and if Nebius finishes under 55, well, then there's going to need to be some action here. But you can see that stock has really tried a couple of times to break out. It just hasn't had it. So the put concept, if we were managing live over the last day or two, we may have been able to take ourselves out of that trade for profit. As is, it's going to look like it's going to carry into tomorrow. We'll see how that goes. But I do need to wrap it there, everybody. It's been a busy day for me, busy here on the channel as always. I'm glad you all made it. Thank you so much for participating and responding to my inquiries as we go through this class. I always appreciate hearing from all of you. So thanks for being here. Don't forget, JB and I will be here tomorrow morning at Market Open for Trader Talk. It's 9:30 a.m. Eastern, ETF Friday, live session only, no archive. Be there, or B square. Thanks for being here, though, today. I look forward to catching up with you again real soon, everybody.